Hello and welcome to Session 12 of the Basic Tax course. We're going to begin Session 12 with a review of the Session 10 quiz answer key. I have the Session 10 quiz up on the screen in front of you, and unlike the last several quizzes that we've reviewed, we have lots to talk about. We've had a series of quizzes where there were not too many problems. Most students only missed a few, and there were only a few problem questions. Well, today we have a number of questions that were problems for a large number of students. There's two reasons why students have trouble with the Session 10 quiz. One of the reasons is not reading the question in its entirety, taking each phase of the question step by step and applying every single instruction that's contained in that quiz question. The second part of the problem is basically not knowing the law. You can't win on either count, so you have to know how to read a question and you need to know the law in order to pass this particular quiz. So let's begin with the first problem question in quiz number 10, and that is question number 3. Round-trip transportation is deductible as a qualified educational expense only if the school is away from the general area of the taxpayer's home job location. Where have we ever said that in the course? Nowhere. If the education is business related, the fact that it is in your metropolitan area or in the area of your main job location is completely fine as long as you can show that it's a temporary location and you're traveling to it from home, or it doesn't matter if it's temporary if you're traveling to it from another work location. So if you go from one work location to another work location, that's a deductible expense. If you're traveling from home to a temporary location inside your metropolitan area, that is also a deductible expense. And if you are attending school as a part of your job, to improve your job skills, then that is a qualifying expense, and there's no rule anywhere that says you can only claim that if you travel outside of your metro area or home job location. The next question in line is question number 6. Bob is an interstate transportation worker, and during the year he was on the road away from home for a total of 250 days. After applying the special meal rate limitation for transportation workers, what is the total standard meal allowance that Bob can claim? Well, there's a couple of things you need to know about tax law to pass this question. The first one is, what is the meal limitation for transportation workers? That's 80%. Second, what is the daily per diem allowance for transportation workers? Well, that's $59 a day. So once you've got those two pieces of information in your head, it's a simple question. The daily per diem rate is $59, so you take 59 times 250 days on the road times the 80% limit, and you're left with $11,800. That is the correct response. Question number 6. The correct answer is D. The next question in line is question number 7, and you can see I've got colored ink running everywhere here. This is to really highlight the important parts of this problem and segment it. And if you start to really segment a problem into its component parts, the way you see I've done here, you can start to pick out all of the important pieces that you need to interpret in order to come up with the correct answer. So you are an employee of ABC Company, and during the year you drove your car a total of 25,000 miles, of which 20,000 were business miles. You were claiming actual expenses, and your total operating costs for the car were as follows, and we have those listed. Rounding to the nearest dollar, what is your allowable job expense before applying the 2% limit? So we're just figuring out the expense amount. We're not worrying about any limitation, just figuring the actual expense that can be deducted. So let's start at the top with the number of business miles. 25,000 total miles, of which 20,000 are business. So 20,000 divided by 25,000 is 80% business use. The actual expenses of operating the car are shown here, and your job is to sort through what's allowable, what's not allowable, and to apply a limit, if any, to any of the deduction amounts. So we have gas, maintenance, new tires, and insurance. We also have depreciation. All of those are deductible auto expenses that must be multiplied by the 80% business use limit. So yes, these items up top are 80% deductible, and yes, the depreciation is 80% deductible. But interest on the car loan, that is not a deductible expense for employee business expenses. The only types of interest expense that you can deduct on Schedule A are home mortgage interest, investment interest expense, qualified mortgage insurance, that's pretty much it. So any other type of interest expense you have, as far as Schedule A is concerned, is non-deductible. And this includes credit card interest on your business credit card that you use as an employee and auto loan interest that you pay on an auto you use as an employee for your work. So the interest is non-deductible. And then finally we have this parking, this business parking. Well, parking is 100% deductible. Well, if it was a business trip, the parking is 100% deductible. And if it was a non-business trip, none of it is deductible. We've gone out of our way to tell you that this was business-related parking, and therefore it's allowed in full. You don't lump it in with the other expenses that are prorated based on business percentage use. You claim the parking in full. So let's add these numbers up. We take $3,500 plus $1,500 plus $450 plus $1,200 plus $2,300, and we multiply those by 80%. The total is $8,950. We multiply that by 80%, and we get $7,160. The next thing to do is to add in that business parking expense of $250, and we get $7,410, which is why B is the correct answer. The next question in line is question number 8. You are an employee under a non-accountable plan. Your employer reimbursed you for the following expenses through a meal and allowance plan. Well, non-accountable is very important. When you are under a non-accountable plan, you report expense allowances as income and treat all allowable expenses as deductions. So what this means is we're not worried about how much the employer reimbursed. We're just worried about figuring the allowable expense deduction that we can claim. The next piece of information the problem provides is that the AGI for the year is $40,000, and based on the expenses shown, what is your allowable deduction for employee business expenses after the 2% income limitation is applied? So let's go through the expenses. We have the car, we have the education, and we have the full cost of meals. Well, remember that we have to apply a 50% limit to the cost of meals, and so that means that the $500 meal expense equates to a $250 deduction. So we're going to take $3,500 plus $1,000 plus $250, and we get $4,750. The next step is to figure the 2% limit on the AGI. If the AGI is $40,000, 2% of $40,000 is $800. We're going to subtract $800 from the allowable expense of $4,750, and we're left with $3,950, which is why A is the correct answer. Question number 10. Haas receives a weekly allowance from his employer under a non-accountable plan as a reimbursement for his business expenses. Haas's expenses are greater than his allowance. Which of the following is true? And we give you number A, Haas does not deduct his expenses because his employer does not include his allowance on his W-2. Well, that's false. When you're under a non-accountable plan, your employer does report the income on the W-2. So A is completely the opposite of the truth. Number B, Haas claims a full deduction for his expenses on Form 2106, and his employer will include his allowance on his W-2 as wage income. That is the true statement. Number C, Haas files Form 2106 to claim his expenses, and he reports reimbursements he receives from his employer on the form. That is false, because under a non-accountable plan, he doesn't report anything to his employer, and his employer doesn't reimburse him. All that happens is his employer gives him an allowance, and Haas spends it as he will. And number D, none of the above. Well, that was not a correct choice. The next question is question number 14. In October, you flew to Sacramento on business. You stayed 4 days for business and then decided to nip up to Lake Tahoe for 3 days before flying home. You had the following travel expenses. We have airfare of $600, hotels in Sacramento of $700, and a meal per diem for Sacramento at $61 per day. Well, if we're in Sacramento for 4 business days, that would be $61 a day times 4 days times 50%, and that gives us a $122 meal deduction. Now, of course, the personal side trip to Lake Tahoe for hotels and the cost of meals is not going to be deductible at all. That's a personal trip. It is not a deductible business expense. So we're left with these amounts in green being deductible, with the exception of the meal expense line. We're not going to take 61. We're going to take 122. The question reads, what is your deductible travel expense before applying the 2% limit? So we're going to take 600 plus 700 plus 122 equals 1,422, which is why C is the correct answer. Number 16, you are operating a not-for-profit carpool. You received payments from your passengers who share a ride to work with you each day. Which of the following is true? A, you should include the income as other income on line 21 of your Form 1040 and claim your expenses as miscellaneous deductions on Schedule A. That's not true. Essentially, this is not a business that you're running. B, you do not include the payments you receive in your income and you do not claim your expenses as a deduction. That is the correct answer. You're just sharing expenses, ride sharing with people who ride with you. And number C, you should claim actual expenses because you are running your car for hire. We've just finished telling you that you're not running it for profit, so no. Number 17, you live in Seattle and your spouse and kids live in Seattle. You are temporarily assigned to a 15-month job at Nike in Beaverton, Oregon. Which of the following is true? Well, firstly, I want to point out this notation I made for you in yellow. Because your assignment in Beaverton is more than 1 year, the job is not considered to be temporary as far as the IRS is concerned. The job is more than a year, and therefore it is your tax home. What that means is you can only claim expenses for business travel away from home when you are traveling away from your tax home. So what the correct answer is therefore going to be C. You cannot deduct any of the costs of traveling between your main home and your temporary home in Beaverton. Because when you're in Beaverton, you are at your tax home. And if you are traveling from Beaverton to Seattle to see your family on the weekend, that's actually personal. It's not business. In order for that travel to be deductible between your tax home and your home in Seattle, you'd have to be able to show that the job is temporary for tax purposes, and temporary means a year or less. Now, if you were in Beaverton for a year or less, you would be able to deduct the cost of visiting family on weekends up to the cost of lodging had you stayed in Beaverton. But this 15-month equation here means that A is false, and the correct answer is C. Number 19, Rick took a client to dinner after an all-day business meeting. He hired a cab to take them from the office to the restaurant and back again. The cab fare totaled $15. The cost of the meal was $125. Rick left a $25 tip. Rick was not reimbursed for the cost of these expenses. What is his allowable deduction before the 2% limit is applied? Well, what stumps most students up on this particular equation is what to do with this $15 cab fare. Is it a part of the entertainment expense or not? And the answer is no. It's a transportation expense, so it is not considered to be a part of the meal. Therefore, we keep the $15 and hold that out and look to the cost of the meal directly. It was $125 for the meal plus a $25 tip. Then we multiply the 50% limit to come up with a cost of $75 for the meal. We then add back in the cab fare and we come up with $90 of expense, which is why C is the correct answer. Number 20, which of the following is a deductible educational expense? An attorney studies for his CPA credentials because he wants to practice business law. Well, if an attorney goes to school to earn CPA credentials, when he's done with that, he would be a CPA, and he would be able to work in a new profession as a CPA. So A is definitely out. B, a teacher studies for her PhD so she can become a school administrator. Well, Pub 17 specifically states that the cost of attending school to move from one teaching position to an administrative position within the education profession is not studying for a new career and is allowed. That's a very specific thing that IRS goes out of its way to say in Pub 17. Number C, a law school graduate pays $400 to take the Oregon bar exam. That would be not allowed because the cost of entering into a new career is not deductible. Number D, a police officer from Kansas must obtain a bachelor's degree before he can work for the Portland Police Department. This one's a stumper for students, and it actually was for me as an instructor for many, many years. I wasn't sure which way to go because it sounds an awful lot like number B. You know, if a teacher can go to school to move up in the realm, why would it matter if a police officer moves from Portland to Boston or Boston to Portland or Kansas or wherever? Why would that matter if you're a police officer and you move to a new city and then you still are a police officer but you have to go to school before they'll hire you? Well, one of the things that is said about the deductibility of education expenses is you cannot be required to take those education expenses as a minimum requirement of the job. And if Kansas does not have a minimum requirement of a bachelor's degree, but Portland does, and you move from Kansas as a police officer and want to join the Port Inlet Police Department, but they won't allow you to remain full-time or they won't hire you until you have that degree, that is the minimum requirement of the job that you are trying to get, and it is not an allowable expense. So Pub 17 goes out of its way to describe that type of expense as not being deductible. This is something I've spoken to educators at IRS about. It's something when you sit there and analyze it, it basically boils down to that. So in a way, what you need to know is that teachers are special. There's special rules for teachers. They have more relaxed rules than any other career. Number 21, Ben often takes his clients to sporting events and dinner. He is very careful to ensure that these entertainment activities immediately follow a substantial business discussion. His only business expenses were for entertainment and meals. His meal expenses for the year totaled $3,200, and his cost for tickets at sporting events totaled $2,000. Ben's AGI is $45,000. What is his allowable deduction after applying the 2% limit? So this is a very simple equation, really. You take $3,200, you add $2,000, and multiply that by 50% because entertainment expenses, like meal expenses, are subject to that 50% limit. Once you've done that, you have $2,600 as an allowable expense, but you must reduce that expense by the 2% limit. 2% of the $45,000 of AGI is $900, and $2,600 minus $900 is $1,700, which is why B is the correct answer. The next question in line is question number 22. Which of the following is not a deductible expense? Well, we keep harping on costs of obtaining a new job in a new profession are not deductible. Well, travel to seek your first job would be therefore be a no. But business travel to Europe is allowed. Entertainment of clients in your tax home area is allowed. And dry cleaning while on a business trip is also allowed. So the correct answer to number 22 is A. And finally, the mini problem. The mini problem probably wasn't any more complicated than any of the other questions that I've already covered. However, it was asking you to apply all of the various rules that we've been discussing relating to employee business expenses and then fill out the Form 2106. So before filling out the 2106, let's just analyze the information that is contained in the problem. Adam Cartwright incurred the following work-related expenses during the year. He has total mileage of 1,900 and he has 12,000 business miles, of which 4,200 were driven before July 1st and 7,800 were driven after June 30th. He also had 2,000 commute miles and 5,000 other miles. So if we add up the mileage, 12,000 plus 2,000 plus 5,000, we get total mileage of 19,000 miles. To arrive at a business use percent, we're going to take 12,000 and divide it by 19,000. We have 63.16%. So that's a number that I know we're going to need for the 2106, and I've now figured it. Next, we're going to look at the actual expense that's going to be allowed for the business use of the vehicle. We have 4,200 miles before July 1st, and before July 1st for 2011, the standard mileage rate was 51 cents per mile. So 4,200 times 51 cents is $2,142. For the second half of the year, the mileage is 7,800 miles. So 7,800 times 55.5 cents a mile is $4,329. We add the $2,142 and the $4,329, and we're left with $6,471. And when I go over to the 2106, I'm going to enter that amount, $6,471, on both lines 1 and 22 of the form. Next, we have meals at $1,000. Well, we know that meals are subject to a 50% limit, but the Form 2106 does ask for that full $1,000 in column B. So when we get to the form on line 5, we will enter $1,000 into column B. And then we're going to have to enter the amount of employer reimbursement, because we're telling you here that his employer reimbursed 50% of his meals. Well, 50% of $1,000 is $500. So we're going to enter $500 on line 7 of column B. And then finally, we know that the 2106 will then apply the 50% limit, and that's going to give us a $250 amount on line 9 of column B. The next step is to look at the remaining expenses. We have office supplies, and we have education expense, and we have travel. Well, the office supplies are going to get carried to line 4 in column A. The travel has a line all its own. That's line 3 in column A. And then we have the $6,000 of educational expenses. Now, Adam is a salesman. He is a degree candidate in a marketing program, and his educational expenses for the year were $6,000. You might be going, well, is that deductible or not? He's getting a college degree. If you get a college degree, does that mean you can't claim the expense? Well, the IRS does go out of its way to say that the fact that your education costs lead to a degree does not mean that they are not deductible. What they say, though, is that they cannot allow you to meet the minimum requirements of a new career. Well, he is a salesman, and he's getting a degree in marketing. We're not telling you it's going to help him meet the minimum requirements of a new career, and it's pretty easy to surmise that if you are in sales and studying marketing, that could improve your job skills. So we're going to go with the argument that this is an allowable expense, and so the $6,000 will be entered on line 4 in column A of the form. So let's take a look at the form now. And here is Adam Cartwright's 2106. We begin on line 1 by entering that $6,471 of mileage expense. And of course, whenever we enter mileage on line 1, we need to complete part 2 of the form. So let's go there. In part 2 of the form, we're going to enter the date placed in service, but that was not information we provided you in the problem or required you to enter. It wasn't a line we asked about. But on line 12, we did enter information that we did provide you. That's a total of 19,000 miles were put on the car for the year. Line 13 is the 12,000 of business miles. Line 14 is the business use percentage, 63.16% that you see we calculated there. Then on line 16, we enter the commute miles, and in the wording of the problem, we told you that there were 2,000 commute miles. And then finally, the total of all other miles for the year was 5,000. We've answered the questions here just because they do need to be answered, although we were silent on those topics in the wording of the problem. And then on line 22, we've entered $6,471. So moving back to page 1, we've got that same $6,471 on line 1. Line 2 is blank. We didn't provide you any information that would be entered on that line. Line 3, we are going to enter the travel expenses, and we did give you travel expenses. It's a simple one-line description right here, travel $1,200. Line 4, we've entered all other allowable business expenses, and that includes the office supplies of $500 and the educational expenses of $6,000. So we have a total of $6,500. We add up lines 1, 3, and 4 and enter the total on line 6. That's $14,117. Then on line 5, we've entered meals, and the total expense for meals is $1,000. The employer reimbursement was 50% of the meal expense, or $500. And then on line 8, we carry those totals down, $14,171 for other business expenses, $500 for meal expenses. We apply the 50% limit, and we end up with an amount on line 10 of $14,421. So that concludes the review of the Session 10 quiz answer key. Let's now take a look at the Session 11 homework assignment. And let's take a look now at the Session 11 homework answer key. The problem reads that Jim Kirk is single, and he has a son, Mark, born in 2001, who lived with him all year. So 2001 from 2011, that means the son is 10 years old and clearly qualifies for the child tax credit. Jim is a Starship captain for Starfleet. His W-2 is attached. He won $59,250 in the state lottery. Well, that's the first line that we've come across where I know I'm going to have to make an income entry, and that would be to Form 1040, line 21. Let's take a look at the next items in line. Jim donated the following items to charity. $2,500 is a check to the National Wildlife Federation. The National Wildlife Federation is a 501c3. That is deductible, and this entry would be made directly on Schedule A. We also have $500 worth of used clothing to Goodwill, and we provide you the information necessary to complete Form 8283, and another $500 of used books to the public district library or the public school district. And he paid $1,000 for the books at Powell's over the years. So we've again provided you information for 8283. We've got 500 plus 500. That's $1,000 of non-cash contributions, so Form 8283 is required. Jim had a comic book collection valued at $50,000 that was stolen. His records show he paid $30,000 for the collection, and he acquired the collection in 1982. His homeowner's policy gave him a $5,000 payment for the loss. This is going to be a loss that can be reported as a casualty loss, so we're providing you with the information necessary for completion of the casualty loss form. Next in line, we have Jim's pet Tribble ate his prize stamp collection. The collection was originally acquired in 1990 and was a total loss. The collection had a fair market value of $2,000 and a cost basis of $500. The collection was not insured. Well, you may have picked up or may not have picked up on the fact that this collection, the destruction of it, is not deductible. Damage to property caused by a household pet is non-deductible, and therefore we're not allowed to claim this expense for Jim. Jim paid the following expenses during the year. We have doctor bill, dentist bill, non-employer plan health insurance. These are deductible amounts, but we'll see from his income that he's not going to be allowed to claim, or he won't benefit from the deduction associated with these items because his AGI limit takes them away. The Exxon credit card interest is not a deductible expense. Mortgage interest goes directly on Schedule A, as are the property taxes. The state balance due on his 2010 return is also a deduction. It will go on the same line as the withholding on his W-2. And then we have the custodial fees to manage his IRA. That is a deductible expense subject to the 2% limit. And here is Jim's W-2. We can see $6,300 of withholding. So let's take a look at how all of this will come out. Mark is a qualifying child. That makes Jim head of household. We've totaled up his medical expenses. They come to $4,150. But again, his AGI is too high and he will not benefit in any way. Jim's state income taxes paid were $7,200. They are reported on Schedule A, line 5, plus the $900 balance due for 2010 means that the amount to enter on line 5 will be $6,300. Jim will report the property taxes paid on line 6 of Schedule A, and the mortgage interest will go on line 10 of Schedule A. Moving on to the casualty loss, the form that we complete for that, of course, is Form 4684. We have a fair market value of the comic book collection, $50,000 before the event, $30,000 cost basis, zero after the event. So his loss is going to be $30,000. It's the lesser of the difference before and after the event of the fair market value or the cost basis, and the lesser of those two numbers is $30,000. Then we have a $5,000 insurance reimbursement that makes his net loss $25,000. We're going to reduce that $25,000 loss by the $100 limit and 10% of his AGI, and Jim cannot deduct the cost of the stamp collection that his Tribble ate. The IRA custodial fees go on line 23 of Schedule A. And Jim's AGI is $169,250, so 2% limit is just going to wipe out any potential to deduct those custodial fees. 2% of his AGI is $33.85. He doesn't get to benefit from that deduction. Also, even though his son Mark qualifies Jim for the child tax credit, Jim's AGI is high enough that he is phased out and will not benefit from that credit. He doesn't get it after all. And here is Jim's 1040 form. You can see that we've allocated him the head of household filing status, we've given him his son Mark, and we've checked the child tax credit box. His W-2 shows $110,000 of wage, and the only other income he had for the year was a state lottery win of $59,250, giving him income of $169,250. His AGI is the same number. We get over to page 2 of the 1040, and it's time to fill out the Schedule A. But before we can do the Schedule A, we need to complete the casualty loss form, 4684. On the 4684, we put a description, the comic book collection, and the address where the loss occurred. We enter the cost basis. We enter the insurance reimbursement. We enter the fair market value on the date of the loss, or before the event occurred. We take the lesser of the difference in fair market value or the cost basis, and the lesser number is the $30,000 cost basis, and then we reduce that amount by the insurance reimbursement to get a loss of $25,000. The next step is to apply the $100 limit, and we get $24,900. $24,900 of casualty loss is reduced by Jim's AGI. 10% of his AGI is $16,925. We reduce $24,900 by $16,925, and we're left with an allowable loss deduction to carry to the Schedule A in the amount of $7,975. That amount is entered on line 20. We then enter the allowable medical expenses on line 1, 7.5% of Jim's AGI on line 3. The deduction is 0. We enter the tax deduction for taxes paid. The deduction for real estate taxes paid, line 9 is therefore $89.50. Line 10 and line 19 both show $19,500 of mortgage interest. And on line 16, we entered $2,500 of cash donated to the Wildlife Federation and $1,000 of non-cash donations. The total deductions to enter on Schedule A are $39,925, and that's the amount here. His exemption deduction is $7,400, and his taxable income is $121,925. His tax is $25,000. His withholding on his W-2 is $30,000. That leaves Jim with a $4,675 refund. The only other element left is Form 8283, which we have completed as you see here. So that concludes the review of Jim Kirk's tax return and the Session 11 homework assignment. It is now time to take the Session 11 quiz. Please push pause on video playback and complete the Session 11 quiz. When you are finished, please resume video playback for the Session 12 lecture. But for now, we're going to get on with the topic of today's class, which is federal credits for individuals. Now, the first thing I have to tell you as an instructor is that there are just certain things I like to teach more than others. And my two favorite topics are credits and depreciation. So today we have credits, and I think next week we have depreciation. So hopefully we'll all have a little bit of fun today. Now, what I've noticed is that I made today's class a 3-hour class, this first one this morning, and after looking at it and working on it all weekend, I decided probably it should have been 4 hours. And I do that a lot. I put too much content into a session just because I feel there's so much that's important. However, we will just race through it as fast as we can and touch on what I think is most important. If you have questions, please feel free to chat me during the class. And this session, like all sessions, I do give you reading assignments. And the reading assignments are there for tax preparers who want to be at the peak of their game, who want to read everything there is to read to know that they understand a topic fully. Now, if you're studying, for example, for the enrolled agent exam, I would highly recommend you read every publication the IRS has. If you're studying for Oregon's consultant exam, that also would be the case. You'd want to be reading all of those publications. And then if you just want to be a great tax preparer, that would be another reason to read them. The information I give you in my classes always comes from these publications, rarely from anywhere else. I like to take things straight from the horse's mouth, so to speak. So we're going to move on to the first page of our manual, and this is an introduction to the course. And one of the things I like to point out repeatedly is the difference between a refundable credit and a non-refundable credit, and also the difference between a credit and a deduction. And of course, credits are, well, they're usually better than deductions because they're dollar for dollar. If you have a $100 credit, it's going to mean you saved $100 of tax. And if you have a $100 deduction, it's only going to save you at your rate of tax, which could be a low of 10% or $10, or a high of, say, 38%, 35%, or $35, but never the $100 that a credit gives you. So credits are always the best, which is why I like them the most. But when you get into differences between refundable credits and non-refundable credits, a lot of that just has to do with where on the form that they appear. And so on the next page of your manual, you will see a picture of the back page or page 2 of Form 1040. And what I've done on this particular page is I've highlighted in yellow the credits that we're going to be talking about today, and in pink are the credits that we're going to be talking about in our class later today, which is federal credits for families with children. So credits that have anything to do with children, including the child tax credit, the earned income credit, the adoption credit, the child and dependent care credit, those are going to be in this afternoon's class. For this morning, we're going to talk about all of the credits that you see in yellow, including the foreign tax credit, education credits, the retirement savings contribution credit, residential energy credits, other credits from Form 3800. Actually, we're not going to cover that one. That's the general business credit, but it was on the same line. It was hard to not highlight it. That is covered in a different course that we will offer later on in the, probably into June, called Federal Tax Credits for Business. So we'll not be talking about the general tax credit today, or the general business credit today, but we will be talking about 8801, which is the credit for prior year minimum tax. And then this box here, C, well, that's all of the other credits that they ran out of space for. They're the write-in credits. You check the box and write the name of the form that you filled out. We're going to talk about those as well. Further down the page, you'll see we have something in the payments section. And of course, that's the key difference between a refundable credit and a non-refundable credit. Non-refundable credits appear in the upper half of the back page of Form 1040, And the best that a non-refundable credit can do for you is reduce your tax to 0. And of course, your tax is the number that appears on line 44. You go to the tax tables or the tax rate schedules or other worksheets to figure out the tax that is going to appear on line 44. If you're subjected to alternative minimum tax, you'll enter that on line 45. And you get your total tax on line 46. Then if you're eligible for credits, we start to subtract those out, of course, based on your entitlement to them. And we get to a point where we total up all the credits on line 54. But the rule with credits is that they can never be more than the tax on line 46. So the best a non-refundable credit can do is get your tax to 0. You're never allowed to have a number on line 54 that is more than line 46 that would have the effect of making line 55 a negative number. Can't be done. The form rules just don't let you do it. There is the odd, rare credit that provides for carry forward, such as, for example, the foreign tax credit. If you can't use it all, it doesn't allow for a carry forward. But most credits, if you can't use them, they're gone. Disappeared, gone off the planet forever. But when we get into refundable credits, things are different. In refundable credits, the money that is showing on the lines, 66 all the way through 71, is money that the government will give you. And that money can come back to you in the form of a refund or a payment. And that's why they appear in the payment section. And the first credit we're going to talk about today is the foreign tax credit. And why is it the first one? Well, it's the first one on the form. So when I teach a class, I try to take each topic in the order that it appears on a form. And so today's class, we will be taking credits in the order that they appear here. And the first one in line is the foreign tax credit, which is claimed on line 47 of the Form 1040. And the purpose of this particular credit is to relieve the taxpayer of the double burden of paying tax to a foreign country on their income and then paying tax to the United States on that same income. So the purpose is to eliminate that double taxation. But one thing that will never happen is the IRS will not allow you to use taxes you paid to a foreign country to reduce the amount of tax you pay to the United States on income that is sourced to the United States. So the purpose of the Form 1116 is to identify the foreign income, the type of foreign income you have, and the amount of tax that the foreign country is imposing on that income. Then the United States looks at how much income it is imposing on that same foreign income to help you determine the amount of credit. But you would not be allowed to have American income sourced to the United States eligible for a foreign tax credit, because a foreign country would not be taxing your American income. Also, in many situations, it is possible to take an itemized deduction for taxes you pay to a foreign country. And you should decide which is most beneficial for you. Am I better off claiming an itemized deduction for the foreign taxes that I paid, or am I better off claiming the foreign tax credit for those foreign taxes that I paid? Generally, you can choose to claim the deduction or the credit on a year-by-year basis, but in no year are you allowed to do both. So if in 2011 you decide to itemize deductions for foreign taxes paid, you would need to do it for all foreign taxes paid in 2011. But if you move forward into 2012, in 2012 you can make a new decision to either claim the credit or the deduction. So it's only the rule that you can't do both in the same year. Now, most people will benefit from the credit more than the deduction. And this is because a credit reduces your actual U.S. income tax on a dollar-for-dollar basis, while a deduction reduces only your income that is subject to the tax. You can choose to take the foreign tax credit even if you do not itemize your deduction, so that's another benefit. You are then allowed the standard deduction in addition to the credit, and if you choose to take the foreign tax credit and the taxes paid or accrued exceed the credit limit for the year, you can be using a carryover, or you can claim a carryover going forward or a carryover going back. And typically the rule is you go back 1 year and then forward up to 10 years. And of course you cannot do that if you claim the itemized deduction. Now, if you make the choice to either claim the foreign tax credit or the itemized deduction, you must do so for all taxes paid in that year. You can't take a deduction for some taxes and a credit for other taxes in the year. Now, one of the things that the foreign tax credit has you do is divide your income into separate categories. And I can remember looking at Form 1116 for the first time and scratching my head and going, what are all these categories of income? My client paid taxes on wages, and it doesn't list wages as a category of income. So what do I do? And that was back in those days. We had a book called Package X. I don't know if you remember it. We didn't go on the internet to find form instructions back then. We had Package X. And we opened up Package X and read the instructions. And I loved reading form instructions. That was the highlight of my day. And it was at that point that I learned that wages were general category income. So as with anything in life, reading the instructions can help, whether it's joining our live webinar class, reading the instructions can help, or if you're trying to figure out how to fill out a tax form, reading the instructions will help. If you're using tax software, there's probably that help function that I certainly use frequently. But we're going to talk about some of those categories of income beyond kind of the basic humor there. Now, there are 5 categories of income indicated on the front of Form 1116. I'm going to zoom in a little so you can see it better. And you can see that we have passive category income, general category income, Section 901J income, certain income resourced by treaty, and lump sum distributions. Now, the only foreign tax categories my clients really ever fall into are categories A and B. Passive category income really includes income such as dividends, interest, royalties, rents, annuities, gain from the sale of non-income producing property, gains from foreign currency or commodities transactions, and capital gains not related to the active conduct of a trade or business. So investment income. Passive category income is typically investment capital gain type income, and also interesting rents and royalties, and annuities. General category income includes things like wages and self-employment. So general category income is income that is not passive category income or income described in those other 3 categories with the weird names you can't remember. General category income includes things like wages, salaries, and overseas allowances of an individual who is working as an employee, income earned in the active conduct of a trade or business, gain from the sale of inventory or depreciable property used in a trade or business, financial services income, and something called high taxed income. Generally, the 4 following tests have to be applied to any tax before you can make a decision about whether or not you are allowed to deduct it. Firstly, of course, you have to peg it into a category, and it has to be a category that is accepted. But beyond that, you have to meet these 4 tests. The first one is the tax has to have been imposed upon you. That means the foreign country is telling you are responsible for paying it. You have to have paid the tax, or you have to have accrued the tax. And accrued the tax means that you owe it, even if you haven't paid it. There has to be a legal and actual foreign tax liability, so it isn't enough for the foreign country to say, yeah, this tax should be paid. They have to say that you are required to pay it. And the tax must be an income tax or a tax in lieu of an income tax. Taxes imposed on the following forms of income qualify for the credit: income tax, war profits, and excess profits taxes paid or accrued on a foreign, or paid or accrued to a foreign city or province. I think it's kind of odd or funny that they include war profits in there. It's just not one of the things I would think of. You can claim a credit only for foreign taxes that are imposed on you by a foreign country or U.S. possession. For example, a tax that is deducted from your wages is considered to have been imposed upon you. Also, I find this interesting, for foreign tax purposes, all qualified taxes paid to U.S. possessions are considered to be foreign taxes. And 2 examples of foreign possessions are Puerto Rico and American Samoa. Now let's take a look at some of the foreign taxes that are not eligible for the credit. You cannot take a credit for the following types of taxes: taxes on excluded income, taxes for which you can only take an itemized deduction, taxes on foreign mineral income, taxes from international boycott operations, a portion of taxes on combined foreign oil and gas income, taxes of U.S. persons controlling foreign corporations and partnerships who fail to file required information returns, or taxes paid to a foreign country that you expect will be refunded. So oddly enough, we have this rule without having to do with the foreign tax credit as well. If you're itemizing your deductions, the IRS says that you're allowed to claim a deduction for taxes you pay to the state, but you're not allowed to claim a deduction if you expect those taxes to be refunded. Or that you pay the taxes in knowing that they will be refunded. I guess that's the wording that they have on it. So with the foreign tax credit, you're filing your foreign tax return, and if you're anticipating that you're going to be receiving a refund of some of that foreign tax, or at least you know that you will be receiving a refund of it, the IRS says you can't claim a credit for what you know will be refunded. Also, taxes on excluded income, this is self-evident. You cannot take a credit for foreign taxes paid or accrued on certain income that is excluded from U.S. gross income. That is, if the United States is not going to tax it, you can't claim a credit for foreign taxes paid on it. Part 1, which is page 1 of the form, is divided into 2 sections. The first section is used to report the amount of foreign income that you had, and the second section is used to report the deductions and losses. So let's take a look at that. Session 12 password number 1 is WEST, W-E-S-T. So education credits. There are 2 of them that we can claim these days. There used to be a third one, or well, you could say there's always been 2, but we changed one. Of course, what was used to be called the Hope Credit turned into the American Opportunity Credit a couple of years ago. And today we're dealing with the American Opportunity Credit rules and the Lifetime Learning Credit rules. Now, the American Opportunity Credit was originally set to be only a 2-year credit for tax years 2009 and 10. And then it was extended through 11 and 12. So we're looking at current law for 2011, and the rules for the American Opportunity Credit will carry through into 12. And at the end of 2012, unless our federal government does something to extend it again, the American Opportunity Credit will go away, and presumably the Hope Credit will return to us. And the American Opportunity Credit is, of course, a whole lot better. It's a better deal in all kinds of ways. And then we have the Lifetime Learning Credit. If you have education expenses but you cannot qualify for the American Opportunity Credit, the Lifetime Learning Credit can be a great way to go. Now, both credits are affected by phase-out limits, and you will see that most credits are affected by phase-outs. That means that as you're earning money and your income rises, your ability to claim a credit may, well, disappear. Sometimes you just phase out so you get a lower rate of credit. Sometimes you lose the credit completely. And with the education credits, you can lose them completely. Now, the phase-out range for the American Opportunity Credit is actually a respectable range, $80,000 to $90,000 of income. And if you are married filing a joint return, it's $160,000 to $180,000 is the phase-out range. Now, the old phase-out limit that applied to the Hope Credit was the same that applies to the Lifetime Learning Credit. And for a single person, it's only $51,000 to $61,000, or for a married couple, $102,000 to $122,000. And quite frankly, I found in my income area, that is the city of Portland, the income levels that we have here, that most single parents who could afford to send their kids to college earned more than the phase-out. So head of household filers who were paying for their kids to go to college nearly never got the credit, or almost never got the credit. But with the American Opportunity Credit, the phase-out range is significantly higher, and so I'm finding a lot more people are able to claim this credit than were able to claim the Hope Credit. But let's look at the credits in turn and the rules that apply to each. As with all credits, you have to meet all of the tests in order to claim them. The first rule is, with regard to the American Opportunity Credit, is the limits. And the amount is $2,500 per eligible student. Under the Hope Credit, it was only $1,800. The rate at which you calculate the American Opportunity Credit is 100% of the first $2,000 of expense, and then 25% of the second $2,000 of expense, for a maximum total credit of $2,500 per year if you had $4,000 or more of qualifying expenses. Up to 40% of the credit is refundable. None of the Hope Credit was refundable. It applies to all 4 years of college, and qualifying expenses include course materials. The credit can be claimed by a non-dependent taxpayer student, a dependent student whose parents did not claim his exemption, or a parent of a qualifying student. The American Opportunity Credit is, of course, claimed on Form 8863. So who can claim the American Opportunity Credit? Generally, you can claim the American Opportunity Credit if all 3 of the following requirements are met. You pay qualified education expenses of higher education, you pay the expenses for an eligible student, and the eligible student is yourself, your spouse, or a dependent for whom you can claim an exemption on your tax return. Note that qualified education expenses paid by a dependent whom you claim an exemption for on your tax return or were paid for that dependent by a third party are treated as if they were paid by you. Now, much of tax law says in order to claim a deduction or a credit for something, you have to have been liable for that debt and you have to have paid that debt. But that rule does not go with the education credits. Education credits, I'd like to say, follow the exemption deduction in most cases. If you are claiming the exemption of a dependent, then you claim expenses that were paid for that dependent regardless of who paid them. So if you paid the expenses yourself and you paid for your child to go to college, then you will claim the expense. And if your child paid his or her own expense and that child is your dependent, then you claim the credit. And if a grandparent paid college expenses for that child, then you claim the credit for that child if that child is your dependent. Now, if the dependent files his or her own return and claims his or her own dependency exemption, then he claims the credit. He or she claims the credit. So in that respect, you say that the credit follows whoever is claiming the exemption for the student. Now, there's one exception to that, and that exception is that if you are a parent who is entitled to claim your child as a dependent and you choose not to, then that child can file his or her own return and claim his or her own credit. And in that case, no one claims the child's exemption. So the rule is, of course, with dependency exemptions, you are entitled to claim an exemption for someone who passes all of the dependency tests. And if you choose not to claim that person as a dependent, it does not mean that they get to claim their own exemption. You cannot claim your own exemption if you are, in fact, the dependent of someone else, even if that someone else says you can do it. You can't. But with the HOPE credit, if that someone else says, I'm not going to claim you, even though you are my dependent, then you can go ahead and file a return and claim your own credit. And you're going to see there's some other things to pay attention to with that. Now, with regards to the American Opportunity Credit and graduate students, most graduate students are not eligible for this credit because it applies to the first 4 years of college education. However, the IRS has determined that a graduate student may be eligible for the American Opportunity Credit if the student was not a graduate student before the beginning of the year. So what that means is you've been enrolled in college and you come up to May of 2011 and you graduate. That would be the normal pattern, correct? So in May of 2011, you could, up until that point, so January 1 of 2011 through May of 2011, you were not a graduate student. You were enrolled in the first 4 years of your degree program. And if during that window of time you paid qualifying expenses, you can claim the American Opportunity Credit for those. The year clocks on, and instead of going out into the workforce, you decide to enroll in a graduate program. Now that you're in a graduate program, you're going to be paying education expenses that are not associated with the first 4 years of college. And because they're not associated with the first 4 years of a degree program, they're not eligible for the American Opportunity Credit. Now, in prior years, the instructions for Form 1098-T stated that if the graduate student box was checked on the form, then the student was not eligible for the American Opportunity Credit. But the IRS found that there was some confusion, and so it has reworded the instructions for the form to allow the credit for graduate students who meet all tests for claiming the credit. This change affects students essentially only who have finished a 4-year degree program during the current year and then entered into graduate studies. So long as the student has not been used to claim the credit in 4 or more earlier years and was at least a half-time student who has not completed the first 4 years of a degree program, then the credit can still be claimed in 11 even if that student became a graduate student during the year. Now, who cannot claim the American Opportunity Credit? Well, we just talked about graduate students not typically qualifying for the credit, but you cannot claim the credit if any of the following applies. Number one, your filing status is married filing separately. Of course, married filing separately loses out on all kinds of tax advantages, not the least of which is the education credits. If you are listed as a dependent on the exemption section on another person's tax return, you are not allowed to claim the credit. If your modified adjusted gross income is more than $90,000 or $180,000, depending on your filing status, you're not allowed to claim the credit. If you or your spouse was a non-resident alien for any part of 2011, and the non-resident alien filing the return did not elect to be treated as a resident alien for tax purposes, You're not allowed to claim the credit. And finally, if you claim the lifetime learning credit or a tuition and fees deduction for the same student in 2011, you cannot also claim the credit. So we've looked at who cannot claim the credit. One of the people who can, or the person who can claim the credit, is a qualifying student, and so we need to look at what is the definition of a qualifying student. To claim the American Opportunity Credit, the student for whom you pay qualified education expenses must be an eligible student. This is a student who meets all of the following requirements. That is, the student did not have expenses that were used to figure an American Opportunity Credit in any 4 earlier tax years. This includes any tax year in which you claimed the HOPE credit for that same student. Also, the student must not have completed the first 4 years of post-secondary education, and the IRS defines that as generally being freshman, sophomore, junior, and senior years of college. You cannot have completed all 4 of those years before 11, but you can, of course, complete them in 11. For at least one academic period beginning in 11, the student was enrolled at least half-time in a program that leads to a degree, certificate, or other recognized educational credential, and the student has not been convicted of a federal or state felony for possessing or distributing a controlled substance as of the end of the year. I've often wondered why that rule is there. It's always been there under the HOPE credit rules as well, that a felony conviction for drug for controlled substances, that's a weird rule, but it's not new. It's been there since 1998 when the HOPE credit first came out. Yeah. Oh, I've got a student in the classroom commenting it's also on the FAFSA applications. Apparently, if you get into drugs, your life's over. Okay. Overview of the American Opportunity Credit. This is a table from publication 970. And it summarizes the rules for the American Opportunity Credit quite nicely. Firstly, the upper limit or maximum credit is $2,500 per eligible student. That means if you have more than one student, you can claim more than $2,500. And it's not uncommon to actually have a family with 2 kids in college at the same time, and their credit could then be $1,000 or $5,000, of course. The phase-out range is $180,000 if married filing joint, or $90,000 if single. If your income is higher than those amounts, you cannot claim the credit. 40% of the credit is refundable. The rest is not. The number of years you can claim it for is 4. It is available only for 4 years, including any year that the HOPE credit was claimed. The type of degree required, the student must be pursuing a degree or other recognized educational credential. Number of courses. The student has to be enrolled at least half-time for one academic period that begins during the year. No felony drug conviction. What are the qualified expenses? Because if we probably remember that under the HOPE credit, we were allowed only tuition and fees and course materials that were purchased directly from the institution as a condition of enrollment. But with the American Opportunity Credit, things are much more flexible. You are allowed tuition and fees required for enrollment, but you are also allowed course-related books, supplies, and equipment, and they do not need to be purchased directly from the institution in order to qualify. And the payments for the academic periods, you have to make a payment in 2011 to be able to claim the credit for a payment in 2011. You cannot make a payment in 10 and claim it in 11, and you can't make a payment in 12 and claim it in 11. But not only that, if the payment that you made in 11 was for a time in the future, that is a future year, you are only allowed to claim the credit if the payment was for an academic period that begins in the first 3 months of 2012. So you could see it would be easy that you're enrolling a student in the winter term that starts in January of 2012, and you're making the payment for that in November or December of 11. And the IRS says so long as that academic period does begin in January, February, March of 12, you can claim the credit in 11, even though the payment is for a future year. But if you're making a payment in 11 for an academic period that would start, say, in the summer of 2012, you wouldn't be allowed to claim it in 11. The next credit to talk about is the Lifetime Learning Credit. The Lifetime Learning Credit helps parents and students pay for post-secondary education. For the tax year, you may be able to claim a lifetime learning credit of up to $2,000 of qualified expenses paid for all eligible students who receive or paid out educational expenses. So the difference between the American Opportunity Credit and the Lifetime Learning Credit in key is that the Lifetime Learning Credit is 20% of your qualified expenses, but it's up to $10,000 of expense. So 20% of $10,000 is a $2,000 credit. It's a pretty sizable credit. But that's it. It can never be more than that on a tax return. Whereas with the American Opportunity Credit, it's up to $2,500 per student with really as many students as you are claiming as dependents on your return. But let's look at some of the benefits of the Lifetime Learning Credit and why someone might use it over the American Opportunity Credit. Firstly, there is no limit on the number of years that the credit can be claimed for each student. However, a taxpayer cannot claim the American Opportunity Credit and the Lifetime Learning Credit for the same student in the same year. Thus, the Lifetime Learning Credit is particularly helpful to graduate students, students who are taking only one course, and students who are not pursuing a degree. Who can claim the claim the Lifetime Learning Credit? Generally, you can claim this credit if you meet the following 3 requirements. Number 1, you paid qualified education expenses of higher education. You paid the education expenses for an eligible student, and the eligible student is yourself, your spouse, or a dependent for whom you can claim an exemption on your tax return. If you're eligible to claim the Lifetime Learning Credit and you are also eligible for the American Opportunity Credit, you need to decide. And it's not a hard choice. American Opportunity Credit, if you're available for both, is probably going to be the one that you're going to choose. Although I could see potentially, well, potentially you could say, all right, I have a student who paid a bunch of education expense in this year, enough that I'm going to get a really decent credit with the Lifetime Learning Credit, so I'm going to reserve that American Opportunity Credit and not use it this year. That could be a motivation for using the Lifetime Learning Credit because you are limited to 4 years on the American Opportunity Credit. On the other hand, if the American Opportunity Credit expires out of tax law, the danger of using it up is small. So what expenses qualify for the Lifetime Learning Credit? Well, these are more restrictive clearly. You are only allowed to claim the cost of tuition and certain related expenses required for enrollment at an eligible educational institution. The course must be either part of a post-secondary degree program or taken by the student to acquire or improve job skills. So who is an eligible student? Well, for purposes of the Lifetime Learning Credit, an eligible student is a student who is enrolled in one or more courses at an eligible educational institution. Let's compare the rules for the Lifetime Learning Credit with those of the American Opportunity Credit. The maximum credit is $2,000 per return rather than per student. The AGI phase-outs are considerably less. $122,000 if married filing joint, or $61,000 if single. If your income is more than that, you don't get the credit. The credit is not refundable. If you don't have a tax liability, the credit does not help you. Number of years of post-secondary education. Well, there's no limit. You can continue to claim this credit for many, many years through graduate studies, continuing education that you take at qualifying educational institutions. It's available forever until the law changes. Number of years, unlimited. Type of degree, the student does not need to be pursuing a degree or other recognized education credential. Number of courses, available for one or more courses. Felony drug convictions are permitted. I guess that would be a reason. You're enrolled in the first 4 years of a degree program, but you have a felony drug conviction. Is that a question I typically ask my clients when I'm giving them a credit? Do any of your children have felony drug convictions? Because, you know, if they do, they can't have this credit. All right, and the payments for academic periods. Payments made in 2011 for academic periods beginning in 11 and the first 3 months of 12 are allowed. Now let's take a look at rules that apply to both education credits. Filing status. You cannot claim an education credit if you are married filing separate. Individuals for whom you can claim a credit. You can claim a credit for qualified expenses that were paid for yourself, your spouse, or for your dependent for whom you claim an exemption on your return. Expenses that qualify for the credits include qualified tuition and related expenses paid as a condition of enrollment, fees required for enrollment, and for the American Opportunity Credit only, you can also claim expenses for books, supplies, and equipment that are needed for a course of study. Expenses that do not qualify include things like insurance, medical expenses, room and board, transportation, personal living or family expenses. You cannot claim an education credit for any portion of student expenses that were paid through scholarships, Pell Grants, employer-provided education assistance, or any other non-taxable payments, or any expense for which a deduction is taken under the Internal Revenue Code Section 162, which means you claimed it on Schedule A as an employee business expense. Who can claim the credits? You can claim qualified expenses paid directly by you or someone else on your behalf. Expenses paid directly to the institution by someone else on your behalf are considered to have been paid by you. If you claim an exemption deduction for your child, education expenses paid for your child by another person for your child are considered to have been paid by you. If you are claimed as a dependent on another person's return, the expenses can only be claimed on the return of the person who claims you. A dependent can claim an education credit provided his or her exemption is not claimed on another person's return. If there are qualified education expenses for your dependent during a tax year, either you or your dependent, but not both of you, can claim the education credit. But of course, if your child is your dependent, you cannot claim them as a dependent. You can claim an education credit for expenses that were paid with a student loan or loans. The credit is claimed in the year that the expenses are paid and not in the year on which payments on the loan are made. You cannot claim an education credit if your status is married filing separate, you are listed as a dependent on another person's return, you earn too much money, you are filing Form 1040-NR, you claim a tuition and fees deduction for the same student, or you have tuition that was paid for you by your employer or through a scholarship. When must the tuition be paid? It has to be paid during the year. Income levels for the credits phase out. $51,000 for the lifetime learning credit is the start of the phase out. $80,000 is the start of the phase out for the American Opportunity Credit. Double those numbers if the status is married filing joint. Educational institutions that qualify for the credits. You must attend an eligible institution, and an eligible institution generally qualifies for financial aid. Most universities, college, and private vocational schools offering certificates of completion will qualify. No double benefit is allowed. You cannot do any of the following. Deduct higher education expenses on your income tax return, for example, as a business expense, and then claim a credit as well. Also the Pell Grants and so forth. Now, the American Opportunity Credit does have a refundable portion to it. 40% of the American Opportunity Credit is refundable for most taxpayers. However, there are some people who are not allowed to claim the refundable portion, and it's not hard to guess who those might be. Dependents. So if you are a person who is a dependent of another filer and that other filer chooses not to claim you as a dependent so that you can claim the American Opportunity Credit, you are only allowed to claim the non-refundable portion of the credit. You are not allowed to claim the refundable portion. So the rules are, if you were under age 18 at the end of the year or age 18 at the end of the year and your earned income was less than 1/2 of your support, or you were a full-time student over age 18 and under age 24 at the end of the year and your earned income was less than 1/2 of your support, and at least one of your parents was alive at the end of the year, and you are filing a return as single head of household, qualifying widow, or separately, you're not going to be allowed to claim the refundable portion of the American Opportunity Credit. Earned income for purposes of this includes wages, salaries, tips, and other taxable employee pay, also net earnings from self-employment. Support. Your support includes all amounts spent to provide you with food, lodging, clothing, education, medical and dental care, recreation, transportation, and similar necessities. To figure your support, count support provided by you, your parents, and everyone else. However, do not factor in your scholarship. That is not considered to be a part of your support. Now, there are some tables in the manual where you can line up each of the education benefits and compare them. There's scholarships, the American Opportunity Credit, the Lifetime Learning Credit, student loan interest deduction, tuition and fees deduction. It lines each of those benefits up and tells you or compares them. On the next table, we have how the benefits can compute or carry over regarding Coverdell ESAs, qualified tuition programs, which are the Section 529 plans. Education exception to additional early IRA distributions, education savings bond program, employer-provided assistance, and business deduction work-related expenses. These two tables are in here, and they come from IRS publications just for you to peruse in your own time. Now, obviously, you should take some time to coordinate and decide which tax benefit is best for your client. I have seen that some clients or some tax software will line up all of the different deductions, compare them, and put the best one on the return, and other software hasn't got a clue. Drake software is an example of one that doesn't have a clue. So on Drake software, I have to decide what credit is going to benefit my client most. Or are they going to benefit from the tuition and fees deduction more than the credit? For example, if I have a client that's not eligible for the American Opportunity Credit, they may also find that they're not eligible for the Lifetime Learning Credit because they earn too much money. But the income phase-out range for the tuition and fees deduction is less. So I may be able to give them a tuition and fees deduction in lieu of anything else. But it could be that they qualify for the tuition and fees deduction and the American Opportunity Credit, both of which allow higher phase-outs than the Lifetime Learning Credit. So the mind has to be wrapped around all of the rules, all of the phase-outs for each type of deduction and go for the one that's best. And then the last option is, of course, claiming a deduction on Schedule A. And if you claim a deduction on Schedule A for an education expense, you have to be able to show that that education expense is job-related or required by your job to maintain your current position and job skills. And claiming an itemized deduction may be the best way to go again. It's going to give you possibly better deductions than the credit would give you for the Lifetime Learning Credit or the tuition and fees deduction. Session 12 password number 2 is Oregon, O-R-E-G-O-N. There's a little piece of information here about scholarship and fellowship exclusion. There is a portion of the Internal Revenue Code, section 117, and under that code, it says you can voluntarily include non-taxable scholarships as taxable income. Now, the reason that you would do this might be to entitle you to claim an education credit, but you have to be careful. You can't just elect to include any scholarship as if it were taxable. It has to meet a certain requirement, and that requirement is that it be unrestricted. Some scholarship programs, the scholarship is awarded and the money is sent directly to the institution to pay your tuition for you. Other scholarships are cash awards. The scholarship is that you've just received $10,000 to pay for your college education, and you can spend it in any way on that college education. You can use it for food, room and board, equipment, tuition. And as long as 100% of the scholarship is spent on deductible items or things that qualify for the credit, such as tuition and fees, then that scholarship is non-taxable. But you could, in that situation where it is unrestricted, treat it as taxable, voluntarily treat it as taxable so that you can claim a credit. And that can sometimes give a better tax savings. Now, in the manual, I have Form 1098-T, but we are short on time, so I'm not going to read the instructions for Form 1098-T for you. I'm simply going to move on to the next topic of the day, which is the Retirement Savings Contribution Credit. I once had someone come up to me and say, do you know anything about the Savers Credit? It's like, I've never heard of a Savers Credit. But I finally figured out that they were talking probably, I guess, about the Retirement Savings Contribution Credit. So I'm always very precise when I like to call things by what their names are. Now, this particular credit is designed specifically to encourage low to moderate income filers to invest more for their retirement. The credit varies from a low of 10% to a high of up to 50% of the amount that you invest in your retirement account or IRA. You can contribute to your IRA up until the due date of your return, not including extensions, and still claim this credit. So it's feasible to have a client that's eligible for an IRA deduction to put money into their account by April 15th of the year you're filing for, or the year after, well, April 15th of the deadline for the year you're filing for, and then claim an IRA deduction on their tax return and also claim this credit at the same time. We've had a client that, they put $4,000 into their IRA, and the tax benefit associated with that ended up being $2,500 or so with the combination of those two benefits. So who qualifies for the credit? Well, you can qualify if your filing status is single, Married filing separate or qualifying widow, but there are phase-outs on income, and this is the maximum amount of income you can have for those first 3 filing statuses. $28,250. If your income is more than that, you don't get the credit. Head of household, $42,375, and married filing joint, $56,500. You must, of course, made contributions to your retirement account during the year or by the due date of your return if you're putting it into an IRA. You must have been born before January 1, 1994. That means you're at least 18 years old. And you cannot be claimed as a dependent on another person's tax return. And also, you cannot have been a full-time student. So apparently, they don't want you taking this credit and the education credits at the same time. How to claim the credit? You must complete Form 8880. Your credit is based on the applicable percentage rate for your income level that cannot exceed your tax liability or $1,000, $2,000 if you're filing joints. So here are the tables and how the phase-outs work. If your filing status is married filing joint and your income is not more than $34,000, the credit is 50% of the amount you contribute to your pension plan or IRA. If your income is more than $34,000 but not over $36,500, the credit rate is 20%. If your income is over $36,500 but not more than $56,500, the credit is 10%. And when your income exceeds $56,500, you have no credit at all. And essentially, for single, these limits are cut in half. And head of household is somewhere in the middle. So let's take a look at a particular client and how he works. Alec Ramsey is a single filer. He withdrew $2,000 from his 401k plan back on June 30th of 2009. Now, one of the rules about the retirement investment savings credit is that your credit is based upon your contributions after subtracting out any distributions that have occurred in the last 3 years. So when we're looking at a 2011 return, a distribution by Alex in 2009 would be a distribution within the last 3 years. So his prior year distribution must be subtracted from his current year contribution, and he will be allowed a credit on the difference. So I've identified his W-2 here, circled the code D. $3,000 is the amount he contributed to his pension plan during the year, and we're going to have to subtract out $2,000 as an amount he cannot claim the credit on. So let's go over to his Form 8880. The starting point on the form is to enter his current year contributions. Then on line 4, we enter his prior year distributions that occurred within 3 years of the due date of the return. And then we have the difference, which is a $1,000. $1,000, we then look to his income. What is his income? Well, he is a single filer. So we're looking at this column here, and we're finding his income. And his income is in this range right here, $18,250 to $25,500. We follow that across, and you can see it's a decimal 1. So we're going to enter decimal 1 on line 9. Multiply 10% by $1,000. His credit's going to be $100. Now, the next part of the form is used to determine whether he's going to be able to benefit from that credit in full. And you'll notice that virtually every credit form you ever fill out has computations that go on the bottom half. The computations there are used to determine how much of a tax liability you have. Alec's tax liability is $1,004. That's coming off of line 46 of his federal 1040. And if that number on that form were 0, he would not be allowed to claim a credit. But that number is 1,000. He will subtract the credit from that $1,000, and so he's allowed the credit in full. He's going to carry that and enter it on his 1040. So the number on line 11, if it's less than the amount of the credit on line 10, his credit on line 10 cannot be more than the amount on line 11, and he's going to be allowed the credit in full. Okay, residential energy credits is the next topic in line. There are 2 different kinds of residential energy credits that are figured on this form. The first kind, or part 1 of the form, is used to report non-business property credit, and part 2 of the form is used to report residential energy efficient property. And those are kind of like, what do those words mean when you're reading them? And the only way to figure it out is to actually spend some time researching and reading the instructions. And the first year that we were able to really start claiming these credits, I believe, was 2007. So we came out with this residential energy credit in 2007, and at that time, the credit was allowed a maximum of $500 based on 10% of the cost of the improvements. That credit was also allowed in 2008. No credit was allowed at all in 2009. Then in 2010, we got a big step up, 30% to a maximum of $1,500 credit. And that was going to be the end of it. It was a one-year deal only, but we did get an extension through 2011. But for 2011, we're back to the 2007 and 8 rules, which is a maximum credit of $500 or 10%. But while I'm rambling on about all of this, in the background, there's another much bigger credit that people are entitled to, but they have to be much more serious about the types of energy efficiency improvements they're making to their home. So we're going to talk about those two differences. IRS says that an improvement that qualifies for the credit, you can assume it qualifies for the credit if the manufacturer says it does. You don't have to second guess the manufacturer. If they're advertising that it qualifies, then it does. But if you claim a credit, you have to reduce your basis in your property by the amount of credit that you claim. Let's look at part 1 of the form first. This credit has a lifetime limit for 2011 of $500. The non-business credit is divided into two categories: qualified energy efficiency improvements and residential energy property costs. In addition to the $500 limit, the following types of improvements also have additional restrictions. The limit is $200 for windows, $50 for any advanced main air circulating fan, $150 for any qualified natural gas, propane, or oil furnace or hot water boiler, and $300 for any item of energy efficient building property. If the total of any non-business energy property credits you have taken in previous years is more than $500, you cannot claim the credit. And you will see when you're looking on the form itself, it's saying how much credit did you claim in each of these earlier years. If the total goes over $500, you're out and you don't get it. Qualified energy efficiency improvements and qualified residential energy property have different rules. Energy efficiency improvements and energy property both have that same $500 limit, but where you put your expense on the form varies, and whether or not you are allowed to claim a deduction or a credit for labor or installation varies. When you're dealing with qualified energy efficiency improvements, you are allowed to claim costs for insulation materials, or to put better windows in your house that are more energy efficient, or a more energy efficient exterior door, or even a roof. If you put a new roof on your home and that roof has heat reflective coatings, either a metal roof or an asphalt roof with reflective coatings that reduce heat gain of the home, those are eligible for a credit. And the credit is claimed in the upper part of the form, and labor or installation is not allowed, only the cost of materials. So lots of people get into this insulation thing, and the thing with insulation is it's expensive to install but cheap to buy. So it's kind of one of the ones that's a disappointment. But windows typically are expensive to buy and expensive to install, but then you're limited to only $200 credit on windows anyway. Now let's compare those types of improvements to energy property costs. Under energy property costs, you are allowed the cost of the unit as well as the cost of installation. But of course, with a credit of only 10% and a maximum of $500, it wouldn't be hard to be limited by those amounts, whether you're claiming, even if you don't get to the installation. But it does give you a little extra kick. So qualified residential energy property includes the following: certain electric heat pump water heaters, electric heat pumps, central air conditioners, natural gas, propane, or oil water heaters, and stoves that use biomass fuel. Also, qualified natural gas, propane, or oil furnaces, and qualified natural gas, propane, or oil hot water boilers, and certain advanced main air circulating fans used in natural gas, propane, or oil furnaces. For these items, you are allowed to include the cost of labor in figuring the credit. Here is the form, and the residential energy improvements are reported on line 3. And any prior year credit claimed is shown on line 2. So it asks you, what was the amount you claimed in 2006, 7, 9, 10? Well, I had it backwards. 6 and 7 were the years you were allowed to claim it. 8 we skipped. And then it looks like we had it again in 9 and 10, and then in 11. Line 3, you enter on line 3 the amount paid for energy efficiency property improvements such as insulation and new windows and doors, but do not include the cost of labor. Then on line 6, we enter the amount paid for qualified energy property costs, where we are allowed to claim the cost of labor. And then you can see on line 9, there's this magic $500. The credit cannot be more than that for 2011. Now, part 2 of the form has been around longer. Well, I don't know if longer is the word. It has not been going in and out of favor. Part 2 of the form has bigger credits, more expanded credits. You can claim much more than $500, but you have to do pretty interesting stuff. Not the usual mundane new windows and insulation. We're going to have to be really showing we're green machines here. So the green machine people are people who might do something radical, like install solar electric panels on their roof, or solar water heating, or small wind energy. They actually put a wind turbine on their property to generate electricity for the house. Or they install geothermal heat pump property. Or they have fuel cell property that's like hydrogen that's converting to electricity. Okay, so these types of activities you might imagine are very expensive, and the credits that go with them are very generous. 30% of the costs paid or incurred in 2011 for installation of qualified residential energy property for your home located inside of the United States. But get this, the home does not have to be your main home except for when we're talking about fuel cell property. So it could be your vacation home. Here is the form, page 2, and on lines 15 through 9, the section in yellow, you enter the amount paid for the residential energy efficient property, including solar, wind, and geothermal property, including the cost of installation. On line 21, you enter expenses related to fuel cell property. The fuel cell property has different limits. Not only do you have the 30% limit, but you also have a limit that applies to the cost of the property per kilowatt half hour of capacity. So the maximum credit is going to be $1,667 per 1/2 kilowatt of capacity, or 30% of the cost of the property, whichever is the smaller number. But when we go up and look at geothermal, solar, and wind, you simply look at 30% of the cost of the property. So as you might imagine, if you were getting fuel cell property where you had to compute this, you would have a lot of information used to compute this. I don't have an illustration for you, but it wouldn't be just some obscure number that you couldn't figure out. You also have the ability to do carry forward. If your residential energy credit is more than your tax, you are allowed to have a carry forward. And if you had a carry forward in 10-11, you would enter that on line 26. So no carry forward is allowed for the residential energy credit that you claim on part 1 of the form, but part 2 does allow for a carry forward. So webinar students, those of you who are standing by, I had a person in my classroom today, while I was talking about Alec Ramsey in Form 8880, ask what happens if you do a conversion? Do you have to include that as income? And I said, well, it makes sense that you wouldn't, but I don't really know. I haven't had to deal with that in real life. So the logical thing to do is to read the instructions for line 4, because line 4 tells you. And of course, mentally, I translate that to whatever you entered as income on a prior year return. That's probably the amount to enter on line 4 of Form 8880. But IRS says do not include on line 4, do not include distributions that are taxable as a result of an in-plan rollover to your designated Roth IRA, or distributions from your eligible retirement plan other than a Roth that you rolled over or converted to a Roth, and so on. So there are some exceptions. But in general, if you took a distribution, you're going to have to reduce the amount of money eligible for the credit by the amount of distribution that occurred within the last 3 years. The next topic of the day is the electric car. And of course, we've had electric car credits around for a few years. Actually, I remember when we didn't have credits for electric cars, when all we had was an above-the-line deduction of, I think it was $2,000 that you could claim if you bought a hybrid Prius. And then, of course, we came out with the cars, the credits for purchasing hybrids. But that credit that we normally associate with hybrids expired at the end of 2010 and was not even available at all for 11. But there is a credit that was available in 11 if you happen to be able to get your little hands on one of these electric cars that was on the market in 2011. Now, I live in Portland, Oregon, and Portland, Oregon has a reputation for being a green city. And for that reason, it's also been selected as a test site for launching the Nissan Leaf, and some other green car manufacturers have looked at our city. And so when I'm driving down the road, I see these little Nissan Leafs driving around. They're on the road, and I have seen several of them. Now, I did go to the IRS website to see how many Nissan Leafs had been manufactured and sold, and it was only a few thousand. So based on the rate of observation here in Portland, they must all be here. But if any of you see a Nissan Leaf in your home city, you can certainly let us know by chatting that you have. But anyway, the cars that currently are available for the credit have to be true electric cars. That means that they have a battery that can be 100% dedicated to driving that vehicle, and that the vehicle can drive without gasoline. Now, if the car can operate on a combination of gasoline and electricity, but is able to operate on electricity alone, it still qualifies for the credit. And an example of that is the Chevy Volt. Now, everything I've heard about the Chevy Volt is that the people who bought it love it, but unfortunately it had a crash test and caught on fire. And so the federal government ordered a recall on some battery component that caught on fire in their test. But the consumer reviews of it are that they love it. And I believe that this car stickers for around $40,000. So if you consider that the purchase price of a new Chevy Volt is roughly $40,000, this $7,500 credit is a pretty big bite out of that sticker price. It's a pretty significant credit, and yes, $7,500 is the amount of the credit that the Volt qualifies for. The Volt is a gasoline and electric car at the same time. That means you can take it home, you can plug it into your house, you can then drive it down the road on electricity, and my understanding it goes 20 or 30 miles on a charge. And when the charge dies, the gasoline engine kicks in and you can continue driving it. So that's a pretty cool option. Now, the next one in line is something called a GEM. You can see this picture of the electric GEM here, and then underneath I have a picture of that Nissan Leaf. Now, the Nissan Leaf compared to the Chevy Volt, the Nissan is 100% electric, and I think it goes 200 miles on a charge. So it goes further on a charge, but when that charge runs out, you're stranded. Okay. Now, here are the rules for being able to claim the credit. A qualified vehicle is a motor vehicle, the original use of which starts with you. That means you are the first owner of that car, and it has to have 4 wheels. Fancy that. All right. You have to have acquired it for use or lease and not for resale. It has to have been made by a manufacturer and not in your backyard. It is manufactured primarily for use on public street roads and highways. It has a gross vehicle weight rating of less than 14,000 pounds. It is a motor vehicle for purposes of the Clean Air Act and is propelled to a significant extent by an electric motor that draws electricity from a battery that has a capacity of at least 4 kilowatt hours and is capable of being recharged from an external source of electricity. There is a phase out for this credit. The phase out is when the manufacturer has sold at least 200,000 qualifying vehicles. That's a pretty big number. Let's compare it to the hybrid cars where the phase out was when the manufacturer reached 60,000 vehicles. It took Toyota Prius all of a year to hit 60,000. It took Ford nearly 3 years to hit 60,000. And other than Ford, Honda, and Toyota, no other manufacturer hit 60,000 vehicles with the hybrid car credits. Now we've got an electric car credit where the phase out is 200,000 vehicles. So what this means is it's going to be around for people to take advantage of for quite some time. Now, the vehicles that have been approved as of May 2012 via the link to this site, this is a site on irs.gov, are the vehicles that you see here. Some of them you can see are 2012 model vehicles, and some of them are earlier models. And the credit for all of these vehicles is $7,500 with the exception of the Toyota Prius. That particular vehicle is only $2,500 according to their site right now. So who have we heard of? Well, there's a Chevy Volt. There is the Ford Focus Electric. There is the Nissan Leaf and the Toyota RAV4 EV. Those are the common manufacturers that we will have heard of, but there are many other manufacturers who are vying for a piece of this new market, companies that you have never heard of. How to claim the credit? Well, you have to fill out Form 8936. and you enter the description of the vehicle, the date you bought it, the credit amount. There's room on the form to figure a phase out if more than 200,000 vehicles have been sold. And if so, you have to figure the phase out, but we're nowhere near worrying about that. There's also another kind of electric car out there. This particular credit has been around for longer, but 2011 is the last year for it. And this credit claimed on 8834 is used for slow-speed electric vehicles and 3- or 2-wheeled electric vehicles that run on battery. The credit is 10% of the cost of these vehicles, limited to $2,500 per vehicle. And you can go to this link here to see vehicles that have been approved for this particular credit. Bear in mind that this one does look like a golf cart. However, golf carts do not qualify. It has to be designed for use on public streets. How to claim that particular credit, you fill out Form 8834. And then, of course, we have Form 8910, and this is the form that we use to claim the hybrid car credit. And the hybrid car credit expired at the end of 2010, but the form is still in place for 2011 because there was a couple of items that were still qualifying for the credit, even though they weren't hybrids. And the only one was this car, which is an FCX Clarity Fuel Cell vehicle by Honda. So if you happen to have purchased yourself a brand new Honda fuel cell vehicle, the credit on that baby was $8,000, but that was expired at the end of 2011, so this is the last year for it. There is also still remaining a credit that can be claimed on this particular form, 8910, if you converted a vehicle to a plug-in electric vehicle. And that credit is $4,000 or 10% of the cost of the conversion, whichever is less. Session 12 password number 3 is TRAIL, T-R-A-I-L. There's a note here about alternative minimum tax limitations on these energy credits. Prior to 2010 passage of the Reed-McConnell Tax Relief Act, if you were subjected to alternative minimum tax, you could kiss these credits goodbye. AMT took them away. You go out there and you buy this car and you're all excited that you bought this new electric car, and no credit, sorry, you pay AMT. But for 2010 and 11 only, AMT does not apply to or offset these credits, so you are allowed to claim them even if you are paying alternative minimum tax. But you'll see that 2011 is the end of that frame. So what that means is if you're a higher income individual and you go out and buy an electric car, unless Congress changes something, you may not benefit from the credit that you're all excited about because AMT will take it away. Here is an illustration of how the plug-in vehicle and residential energy credits might compile together on a person's tax forms. We have Bruce Wayne with adjusted gross income of $100,000, and on November 15, 2011, he purchased a new Nissan Leaf. Then in November of 11, he remodeled his home and installed new asphalt roof with granules designed to reduce cooling costs for his home, and the installation charges were $7,000. Bruce's only income came from wages. His W-2 is attached. Prepare his forms 5695 and 8936. Here is his W-2. Let's get busy. So the first one in line is his residential energy credit form. It asks us to enter his address. It asks us, was the energy efficiency item installed on his main home? We have to say yes. And then there is a question, was any of the installation part of construction of the main home? And we say no. He had no credit amount claimed in any earlier year, so line 2 is blank. Then on line 3, we find the line that says metal or asphalt roof that meets or exceeds Energy Star program requirements. What was the cost of the roof, not including installation? It was $9,000. We multiply 9,000 by 10% and we get $900. But of course, the credit cannot be more than $500. So ultimately, his credit is limited to $500. And the amount showing on line 13 is the tax shown on his 1040 before credits. Then we move on to 8936, and this is where he's claiming the credit for his new Nissan Leaf. We enter the description of the vehicle, the date bought, the credit amount. Down at the bottom, again, it's asking you to look at the tax on his federal form because his credit cannot be more than his tax. So the first thing we look at is his tax. We then subtract out the amount of residential energy credit he has claimed to arrive at his tax after the residential energy credit. Then we have to make sure that he still has more tax than he does electric car credit, and he does, so he gets the full electric car credit. And then we move over to the 1040 form, and we would enter the residential energy credit on line 52, the electric car credit on line 53, and we can see here is his tax amount on line 44 starting at $17,928. His total credits are $8,000, leaving him with $99.28 of net tax. We've entered a check mark on box C and entered the code name or the form number for the form. The next credit in line is the credit for prior year minimum tax. There are two versions of this particular credit. One is the refundable version of the credit, and the other is the non-refundable. We talk about both credits in far greater detail in our course called Understanding the Alternative Minimum Tax. We could spend hours talking about how to compute AMT and credits for AMT, and there isn't time for that today. So today we're just going to talk about the basics of this particular credit. To understand the credit for alternative minimum tax, or actually it's not even called that, it's called the credit for prior year minimum tax, you must first understand that there are two different income tax systems operating at the same time, one of which is the regular income tax system that we follow every time we fill out tax forms. And the other is the alternative minimum tax system that's hovering in the background. And most people are never even aware that AMT is out there until they're subjected to it. And they find out they're subjected to it either because their tax preparer tells them or because the IRS tells them that they're subjected to it, or their tax software pops up and screams at them that they're subjected to it. But most people are never aware it exists until that happens. Now, what happens is that under the regular tax system, you are allowed to report your income and deductions in a certain way. But as your income increases, there are certain types of tax deductions allowed under the regular system that are not allowed under the AMT system or are completely eliminated under AMT. Deductions not allowed under AMT include personal and dependency exemptions, the standard deduction, state and local income taxes, home mortgage interest that is not allocable to main home purchase or improvement, investment interest expense, employee business expense, accelerated depreciation, and some Section 179 deduction, incentive stock option exercises, Section 1202 small business stock exclusion, and certain other credits and deduction items. All are thrown out under AMT. And you may have paid AMT in an earlier year because of some or more of these. And if you paid AMT in an earlier year, you may be able to claim a credit for AMT in the current year. However, you're only allowed to claim a credit for prior year minimum tax if the reason you paid the minimum tax was because of something called a deferral item. If you paid the tax because of an exclusion item, you can never have the credit for that tax. So what's a deferral and what's an exclusion? Well, in a nutshell, deferral items are taxes that have been deferred under the regular tax. You're allowed the deduction under the federal tax, and you will eventually be allowed it under the AMT. It's just that AMT doesn't allow it now. And examples of that include incentive stock options and accelerated depreciation in the Section 179 deductions. So it's possible you were able to exclude incentive stock options from your income under the regular tax, but you had to include them under the alternative minimum tax. That would be something that would generate AMT credit. And if you were able to claim accelerated depreciation under the regular tax but not under AMT, that also could trigger a credit for prior year minimum tax. But these items, called exclusion items, will never entitle you to a credit, and they include things like taxes, home mortgage interest, and miscellaneous deductions. The credit for prior year minimum tax is allowed only for AMT that is caused by deferral items. You may be able to claim the credit if you paid alternative minimum tax in 2010, or you had unused minimum tax that you carried forward from a prior year, or you had an unallowed qualified electric vehicle credit. How do you claim the credit? Well, you fill Form 8801 out, And if you want to know how to do that, I'll show you in a later class. Mortgage interest credit. This is a credit that I think is pretty cool. It is not new. It's been around forever, but almost no one that I ever work with ever gets it. And it's largely a factor of not knowing how to apply for the certificate that allows you or entitles you to the credit in the first place and doing it at the time you buy your house. So it's been around for a long time. And when I first got into this business of preparing taxes, I had a few clients that qualified for it, and they would get it on the return. And then they kind of phased out. They refinanced their homes or sold their homes, and I've had no new clients in the last probably 18 years come in that qualify for this credit. And yet the eligibility for it out there is there. I mean, there should be lots of people out there who qualify for it. The question is just where are they? They're not coming to me. But maybe they're coming to you. Or if they're not coming to you but they're interested in buying a home, the least you can do is tell them about the potential for the credit so that they can go out and apply for it if they're eligible. So eligibility requirements, well, you can claim the credit if you meet the eligibility requirements. And those eligibility requirements are determined at the state level. So the federal government is not the one that issues the mortgage credit certificate. It's done at the state level. So when you're deciding that you want to buy your home, you have to see if your state has a mortgage credit program. And if it does, you apply for it at the time you're buying your home. Generally, a qualifying individual must be a first-time home buyer who was purchasing a home in a targeted neighborhood, but what I've observed is if you've not owned a home for 3 or more years, you'll typically be considered a first-time home buyer. There are income restrictions that apply, but I can't tell you what those are because they vary by state and neighborhood. The mortgage interest certificate must be obtained at the time the home is purchased. And following are illustrations of the mortgage interest credit programs from California, Texas, and Oregon. How did I find these? I just typed MCC on the internet to see what came up. And these are states that popped information up. But if you want to know if your state or county offers a mortgage interest credit program, I would type MCC and then the name of your city, state, county to see if anything pops up. And I'm not going to read you what each county has to say, but you can see here that for Santa Clara County, California, the maximum income limit restriction for a 1 or 2 person household is $103,500, and for a 3+ person household it's $119,000. And then it has home purchase price limits for 2001 that can qualify for the credit. When we go over to Texas, Texas's system is quite a bit different, and it gives an example of how their system works. They say this is the mortgage amount, this is your interest rate, 6%, this is the total interest paid in the first year, and the mortgage credit rate for them is 30% for a credit amount of $2,178, but a maximum allowed credit of $2,000 in this illustration. Texas is a little bit different. Most of the credit programs out there work on a formula where the maximum credit is 20% of the interest. Texas is different where theirs is 30, but then it's restricted to a maximum of $2,000. And then here is Portland's. Our credit mortgage interest program is run through the City of Portland Housing Bureau. And in this particular example, the mortgage credit certificate rate is 20%, and an eligible home buyer for a 1 or 2 person household is $71,000, and for a 3 or more person household, it's $81,000. So based on the cost of living in the City of Portland, these are reasonable income thresholds that most people are going to fall under them, and the only thing they have to do is apply for the credit. But if you've bought the home, it's too late. You have to do it before you buy. So let's see how this particular credit works. We have an example. Mary's mortgage interest credit certificate entitles her to a 20% credit for mortgage interest she paid on her certified home mortgage loan. During 2010 or 11, she paid $5,000 of mortgage interest. She is allowed to claim 20% of $5,000 or $1,000 as a credit on Form 1040, line 53. Direct credit off of her tax of $1,000. Interestingly, she is still allowed to deduct $4,000 as mortgage interest paid on Schedule A. So the credit is subtracted from the total interest paid, and the difference between the credit and the interest paid is still allowed as a deduction on Schedule A. So it's one of the few places where I actually get to see something of a double tax benefit. Next up is the credit for the elderly or disabled. This credit is one I get kind of cranky about. It's just a waste of time telling you about it, but it's there. You might get a test question on it. You can't ignore it, so I'll tell you about it. Few people meet the necessary qualifications to claim this credit because in order to claim it, you must meet income restrictions. Those income restrictions are that your income has to be less than $17,500 if you're single, or $25,000 if you're filing a joint return. Plus, you have to have Social Security income that is less than $5,000 for single, or $7,500 if you are filing joint. And the thing is that standard deductions for people who are old enough to be considered elderly, like 65 and above, I mean, the standard deduction plus the personal exemption, I mean, you're almost at $17,000 these days. I mean, you've got this very narrow point where your income is more than your personal deductions, but less than the limit of $17,000 here. And the odd time that I do run across a filer who hits this $17,000 where their income's less than that, their Social Security is more than $5,000, and I just have not had a client qualify for this credit in probably 15 years. Actually, one year I had a client who qualified for it, but then he got a letter from the IRS saying that he hadn't reported his Social Security income. And that was because, well, he didn't know he had it. When I asked him about his Social Security, he didn't know he got it. It was through direct deposit. So anyway, that blew that one. That took me back down to 0 people who ever got it. But here are the rules for it. You have to be age 65 or older, or if you are under age 65, you must be retired on permanent and total disability and receive taxable disability income and did not reach your company's mandatory retirement age as of January 1, 2011. And IRS goes on to define what disabled is. Basically, you can't be capable of engaging in substantial gainful activity. And you have to have a letter from a physician stating that your condition has lasted or is expected to last continuously for 12 months or more, or that will cause you to, well, die. And if you meet those requirements, you can claim it as a disabled person, even though you're not retired or elderly. Here are the income limits. I kind of already mentioned them. The table says you have to look to your overall income, AGI, and then you also have to look at how much income you have from Social Security. And it does say non-taxable Social Security, but I can tell you if your income is only $17,500, your Social Security is not taxed. You're below the threshold where Social Security does become taxed. How do you claim the credit? Well, if you manage to qualify for it, you would complete Schedule R, check box C on line 53 of Form 1040, and enter the amount of the credit on that line. You can also claim the credit on line 30 of Form 1040A. Next up is the District of Columbia First-Time Homebuyer Credit. This one's been around for a long time. It is not new. In general, you can claim this credit if you purchased a main home in 2011 in, get this, Washington, D.C. You and your spouse, if married filing jointly, must not have had any other main home during 2011 in D.C. So it has to be the first home you bought in Washington, D.C. in the last year. Okay, you cannot claim the credit if any of the following applies. You purchased your main home in D.C. after December 31, 2010, and you are eligible to claim the refundable first-time homebuyer credit computed on Form 5405. Or you acquired your home from certain related persons, or by gift or inheritance. Or your modified adjusted gross income is $90,000 or more, or $130,000 or more if filing a joint return, or if you previously claimed this credit for a different home. About the credit or the amount of the credit, it is $5,000 on a single or joint return and $2,500 for a married filing separate return, or the purchase price of the home, whichever is less. I don't know, do houses in Washington, D.C. sell for less than $5,000? The credit is phased out over a range that begins when your modified adjusted gross income exceeds $70,000 or $110 for joint filers, and ends when your income hits $90 or $130. The credit is not refundable and cannot exceed your tax liability. However, you are allowed to carry any unused credit forward until it is used up. So it's one of the few credits that qualifies for a carry forward. Now here in Portland, Oregon, do you think I've ever had a client that claimed this credit? Yes! I have run across this credit more times than I have run across the credit for the elderly and disabled. Once, here in Portland, Oregon. All right, now you're in Washington, D.C. or, in the Beltway area there, I would imagine you run across it a little more often than we do here on the West Coast. Yeah. All right, so now we've finished talking about the non-refundable credits. Let's talk about a few of the refundable credits. One of these credits is, of course, the first-time homebuyer credit. And for most people, that credit expired in May, June of 2010. However, if you were a member of the Uniformed Services, a member of the Foreign Service, or certain employees in the intelligence community, you were given an extra year. And if you meet one of these three criteria, you actually had until May 1st to make a binding offer on a home. Actually, April 30th to make a binding offer on a home, and then of 2011, and then you had to close by June 30th of 11. So I did have one military guy that fell into that category, bought himself a house in Illinois, and he was in a race to do it. He was in Germany during the entire time that the first-time homebuyer credit went on, but his tour in Germany ended. He came back to the United States. He scurried out and bought himself a home there in Illinois and was able to claim this credit in 2011. Restrictions. The following restrictions apply to the credit. It is not available to dependents. The credit is not available if the purchase price of the home exceeds $800,000, and the purchaser has to be age 18 or older on the date of purchase. The credit is the smaller of $8,000 or 10% of the purchase price of the home. Eligible homebuyers making 2011 purchases can get the tax benefit early by claiming the credit on their amended 2010 return, or actually on their original 2010 return as well, or they can wait and claim it on 11. Now, the credit for the excess Social Security tax or railroad retirement tax withheld, this is one that pops up reasonably often and more often than it should. And the reason it pops up more often than it should is that it's given in error by people who are not paying attention to what they are doing in computer software. Now let's take a look at what's causing this. You, as a wage earner, have to pay into Social Security as you're working, and also if you're self-employed through the self-employment tax. But the maximum amount of income for 2011 that is subject to Social Security tax is $106,800. Now, if you work for a single employer for the entire year and that employer pays you $200,000, there comes a point where that employer is supposed to stop withholding Social Security tax because you've maxed out. And that max out for 2011 is $4,486. When you've hit that number, you're not required to pay any more Social Security tax for 2011. But what will happen is if you switch jobs, or maybe your employer does some kind of reorganization during the year, gets itself a new IN, and those two items can cause you to have too much withholding. Now, if your employer does a reorganization or transfers ownership of one company to another, I see these things happen where an employee will get a W-2 for one part of the year where it was under the old company and another part of the year where it was under the new company. And when you add those two together, you've got excess Social Security tax withholding. That's okay. But if you have a single W-2 for the entire year and that single W-2 shows more than $4,486 of withholding on it, that's wrong. And the employer needs to correct that W-2, get a refund of the payroll tax that they paid by filing corrected Form 941s for the payroll reports, and they should issue you a corrected W-2, and they should give you your money that the excess withheld. That's how it should happen. So anyone who's had an employment error or withholding error by an employer should go to the employer to fix the problem. But anyone who has had too much withholding because they worked 2 or more jobs during the same year, they're going to qualify for the credit. Now, how do we sometimes get people claiming the credit on the return that aren't entitled to it? Well, have any of you ever noticed that when you're doing data entry in the computer that the software asks you to enter whether this is the spouse's W-2 or the taxpayer's W-2? And have any of you noticed that if you don't tell the software that it is the taxpayer's W-2 or the spouse's W-2, that the computer software will default to the taxpayer? So you could have a situation where your software assumes that every W-2 you enter belongs to the taxpayer because you have not told the software which W-2 is the taxpayer's and which is the spouse's. I've personally done it in the earlier years when I was green and less experienced in a highly embarrassing fashion, but I've also had tax clients come to me who have received CP2000 letters from IRS when they did their own returns on TurboTax. They've done it to themselves, and I have supervised multiple tax preparers who do it and get caught in the review process that goes on in our office. So that's one of the things that In our tax office, every tax return is reviewed, and one of the things our reviewer looks for is W-2s that have been allocated incorrectly. So I'd like to say we don't see many problems like this coming out of our office, but it is too easy to make it happen and something you should be on the lookout for. But here's an illustration of who does not get the credit. We have works one job and works two jobs are a married couple. One job has one W-2 for the year, and two jobs has, you guessed it, two W-2s for the year. And this is one job's W-2. $50,000 of wage income, and you can see $2,100 of Social Security tax was withheld. Works one job is not eligible for a credit because this is the only job that he had, and that's it. No credit allowed. But we go over to works two jobs, and let's see what happens. Works two jobs were for two employers during the same year. We've got Big Bows Inc. and the second job, okay? And we have wages in box 3 of $50,000, Social Security tax of $2,100, a second job paying $60,000, and another $2,520 of tax withheld on that second job. Well, when you add those two amounts up, you get $4,620. Well, that is more than the maximum required withholding of $4,486. The difference is $134, and guess what? $134 gets entered on line 69. But if we forgot to tell the computer software that we had works one job plus works two jobs, and we treated everything as if it was all works one job's W-2s, well, how much would the system be refunding then? It would add $2,100, and you would see $2,234 on the line instead of only $134, all because you weren't paying attention in your data entry. That's a pretty significant error, a very embarrassing error. It is now time to complete the Session 12 classwork assignment. Please flip to page 53 of your Session 12 student manual and take a look at it with me. This is assignment, of course, involving preparation of a tax return and the use of a number of forms that involve tax credits for individuals, including Form 5695, 8863, and 8936. So let's see what's going on here. Jack and Terry Bauer bought their first home on May 25, 2011 for $249,000 in Lincoln, Nebraska. The Bauers have one child whom they claim as a dependent, Kim, born back in 1991. Kim is a full-time student enrolled in a degree program, and she paid $8,000 in tuition, fees, books, and supplies during the year. On January 25, 2011, the Bauers became proud owners of a brand new Chevy Volt, costing $41,000. Then on October 31, 2011, the Bauers finished installing the following energy efficiency improvements to their vacation home in Colorado. They installed a geothermal heat pump costing $20,000, of which $10,000 was for equipment and $10,000 was for labor. They also installed solar panels at a cost of $10,000. The equipment was $7,000, and in this case, labor was $3,000. The Bauers also had $1,500 of ordinary dividend income. They will take the standard deduction. Their 1099 DIV and W-2s are attached to prepare their tax return. So you can see we have a 1099 DIV here. We then have a W-2 for Jack, a W-2 for Terry. At this point, please push pause on video playback. Complete the Session 12 classwork assignment. When you are ready, please resume video playback for a review of the answer key. And I have the Session 12 classwork assignment answer key up on the screen in front of you. The first item to point out is that Jack and Terry are obviously filing a joint return. Their daughter, Kim, is their dependent and is their qualifying child. However, she is too old for the child tax credit. She does, however, qualify for an education credit. Kim is actually eligible for the American Opportunity Credits. So Jack and Terry will complete Part 1 of Form 8863. They enter in that form Kim's name, Social Security number, and the qualifying expense amounts, and they will be able to claim a credit for her in the amount of $2,500. Now, in completing Form 8863, you should note that there are two parts to the form. Part 1 is used for computing the American Opportunity Credit, and Part 3 is used to compute the amount of credit they qualify for based on their income. In other words, to see if their income is high enough that they will be subject to a phase-out. As their income sits, the Bauer's income is low enough that they are not subject to a phase-out and they will be allowed to claim Kim's credit in full. Part 2 of Form 8863 is used to figure the lifetime learning credit, but because the Bauers are better off claiming the American Opportunity Credit, that is the credit that we have given them. The next form we complete is Form 5695. We will complete page 2 of that form, and we will use page 2 of the form to figure the energy credits for the installation of the solar panels and the geothermal heat pump. Finally, the next form that the STERCs will need to complete is Form 8936. That form is used to figure the credit on the purchase of the Chevy Volt, and that Volt does qualify for the maximum credit of $7,500. So let's take a look at their finished return. Beginning with the 1040, we've entered the Bauer's names, their filing status. The number of exemptions is 3. When you look at their W-2s, the W-2s for Jack and Terry combined to total $136,750, and the 1099 DIV shows $1,500 of dividend income. They have total income of $138,250. Their AGI is the same number. They will claim a standard deduction in the amount of $11,600. They will claim personal exemption and dependency exemptions totaling $11,100. They have taxable income of $115,550 and tax of $21,138. From this point, it is necessary to figure their credits, and one of the first credits I wanted to point out to you was the foreign tax credit. Attach Form 1116 if it is required. Well, if you took a close look at the dividend form for the Bauers, you might have noticed a number appearing in box 6, and it reads $126 of foreign tax paid. That $126 is entered on line 47 of Form 1040. No Form 1116 is required because the amount of foreign tax on this joint return is less than $300. So they simply take the amount shown on the Form 1099 DIV and enter it on line 47. The next credit in line is the education credit, but the American Opportunity Credit is actually a two-part credit. So on line 49, we enter $1,500 of the $2,500 credit, and on line 66, we enter $1,000 of the credit. We also have residential energy credits in the amount of $9,000. We do need to attach Form 5695. I will show you that in a moment. And we have the credit from Form 8936 for the Chevy Volt in the amount of $7,500. So the Bauers have total credits of $18,126. That is subtracted from the tax shown on line 46, leaving their net tax at only $3,012. So let's take a look at some of these forms. Beginning with Form 8863, and as I already said, in Part 1 we enter the name of the student, the amount of qualifying expense up to but not more than $4,000. So even though Kim's expense was more than $4,000, she will claim expense of $4,000. The first $2,000 of the $4,000 is 100% credited. And then after that, the second $2,000 of the $4,000 is credited at a rate of 25%. So we have $2,000 for the first $2,000 and $500 for the second $2,000 of expense, leaving a total credit amount of $2,500. Now, Part 2 of the form is left blank because they are not claiming the lifetime learning credit. Then in Part 3, we figure the refundable American Opportunity Credit and the limit on the credit. The limit on the credit does not affect the Bauers because their income is less than $160,000. Their income is only $138,000. So they start with the full credit amount of $2,500. They see if they're subject to a phase-out. Their income is only $138,000. They're not subject to a phase-out. So the next step is to determine how much of the credit is going to be allocated to the refundable portion and how much will be allocated to the non-refundable portion. And $1,000 becomes refundable, and the remaining $1,500 is non-refundable. You will see that on line 14 it says refundable American Opportunity Credit. Carry that amount to line 66 of Form 1040, and then enter the difference, $1,500, on line 15. Then line 15 carries down to line 23. And $1,500, according to the instructions right here, says carry to Form 1040, line 49. The next form we have is Form 8936 for the qualified plug-in electric drive motor vehicle. It's not a terribly complicated form. Line 1, you enter a description of the vehicle. Line 3, we enter the date bought. And line 4, we enter the tentative credit amount, which is $7,500. Now, in the next section of the form, credit for personal part of vehicle, there is a request on line 12 to enter the amount from 1040, line 46. What is that number? Let's go look. Line 46 is the total tax. The next question is, enter personal credits from Form 1040. What are the personal credits that have been entered? Well, there is the foreign tax credit in the amount of $126 and the non-refundable American Opportunity Credit in the amount of $1,500. Both of those credits appear earlier on the Form 1040, and those credits will work first to reduce the tax. The tax starts at $21,138. It is reduced by the American Opportunity Credit, non-refundable portion, and the foreign tax credit. But even after subtracting out both those credits, the Bauers still have a tax liability of $19,512. That is more than the $7,500 credit for the car, so the credit is allowed in full. The next step is to complete page 2 of the residential energy credit form. And we start with the qualified solar electric property costs at $10,000. That includes both the cost of the equipment and the installation. We then also enter the qualified geothermal heat property, again including the cost of equipment and installation. We add up those total expenditures at $30,000 and then multiply the total by 30% to get another credit in the amount of $9,000. There is a question here, was this qualified fuel cell property? The answer is no, it is not. Then we carry the total credit down to line 27 and again take a look at their tax liability from line 46 of the Form 1040. We start with line 46 and then we add up all of the other credits that have already been claimed. That includes the foreign tax credit in the amount of $126. It includes the non-refundable portion of the American Opportunity Credit, and it includes the qualified plug-in electric drive credit. All three of those credits total $9,126. We subtract $9,126 from $21,138, and that leaves us with $12,012. That's more than the $9,000 credit. Therefore, the $9,000 credit is allowed in full. Going back to the Form 1040, we have this net bill or net tax liability after all credits in the amount of $3,012. The Bauers had $13,000 withheld on their W-2, and again we've added in the refundable portion of the American Opportunity Credit. That leaves them with $14,000 of withholdings and credits and a refund in the amount of $10,988. So that concludes the review of the Session 12 classwork assignment. Let's take a look at the homework assignment next. So flipping to page 55 of the student manual, the forms needed for the homework assignment include Form 1040, Form 8863, and Form 8880. Spring Days is single and lives in Brooks Landing, Topeka, Kansas. She has a 17-year-old daughter born in 1994. Spring paid all of the cost of supporting herself and Dora, and during the year she was also a half-time student at Washburn University, where she is enrolled in a degree program and is in her sophomore year. Her Form 1098-T shows her tuition and qualified expenses for the year worth $1,300. This is Spring's first college experience. Spring used money from her student loans to pay the tuition, so her expenses were not out of pocket. In other words, she's paying all of her costs with student loans, so she doesn't have to actually spend her own money. Spring has $1,000 of dividend income and paid $300 of foreign tax on those dividends. Spring's W-2 is attached. Prepare her federal return. We have a W-2 for Spring, and at this point we are at the conclusion of Session 12 of the Basic Tax course. Please complete the homework assignment for Session 12, the reading assignments for Session 12, all of the tests associated with Session 12, and I will see you next time. Bye-bye.